It's I-Day, Inflation Day, that is, in Australia, with Bureau of Statistics figures this morning set to determine whether the Reserve Bank hikes interest rates again. Tradies and postgrads are happier and earn more than everyone else. And Twitter's blue tick reappears on accounts of famous people, even if they're no longer alive. It's Wednesday, the 26th of April, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael. I-Day.
Like I don't know if it's going to catch on. I suppose it happens technically every month now, doesn't it? Now that we're getting a monthly inflation data, so we got a monthly I-Day.
I suppose after yesterday, when you think about things like D-Day, you're allowed to have an I-Day.
I don't know whether you can really put them in the same category.
Well, no, definitely not.
I'm gonna call it now, Sean. I don't think it's going to catch on, and I'm a big fan of trying to introduce new things and make them catch on. This one, I just don't think has what it takes.
Yeah, it's not going to make it. I agree.
No. Look, we'll discuss that in a bit more detail shortly. Obviously not I-Day. We'll actually talk substance, Sean. But there's an interesting conversation coming up. Your interview is after the show with Kate Burley, who is the country manager for Amazon Alexa Australia and New Zealand, which is obviously a supporter of this podcast. I mention them pretty much every day.
Yes, it's a great chat to Kate all about Alexa, where it's come from, where she's come, even why it's named Alexa. That's where we start from, really, and go from there. Also about artificial intelligence, what next in the world of Amazon. It's a fascinating chat.
Yeah, it's a really good chat. It's coming up a little bit later on, but the main story this morning, Sean, is of course I-Day. The release of March quarter inflation figures today are really set to determine whether the Reserve Bank lifts interest rates when it meets next week, just as the housing market shows signs of life.
It is a very big day in the world of economists. The Bureau of Statistics Consumer Price Index for March is due for release at 11:30 a.m. this morning. It will tell us if inflation is heading south, hopefully, and whether underlying inflation, which takes out volatile items, remains sticky. A Reuters poll indicates annual headline inflation will slow to 6.9% in the first 3 months of the year from 7.8% in the December quarter. But the underlying measure preferred by the central bank is tipped to drop only marginally from 6.9% to 6.7%. If the data comes in stronger than expected, the Aussie dollar is likely to rise. The share market is set to fall, pretty much because it will indicate there's another rate rise when the Reserve Bank board meets next week. If the number is weaker, then the opposite will happen. The Aussie dollar's set to fall, the ASX is set to rise, and there'll be real hopes that there won't be any more rate rises.
I'm going to ask you about the idea of this maybe a magic number kind of thing, Sean, but I do need to just come back to one thing very briefly.
You can't help yourself. There's a word in that last sentence or that last paragraph which you're not going to like.
It was sticky.
Mm-hmm.
And you've used it before. You use it quite a bit. Is it an accepted, when you say whether underlying inflation remains sticky, is that an accepted economics term? If I was to go into an economics textbook, it would be there, sticky?
In fact, you would. If you go back to your Dornbush and Fisher, and those who learnt macroeconomics many years ago will know what I'm talking about. Dornbush and Fisher was the textbook you got in first year macroeconomics. Talk about sticky prices. And it's about the fact that prices don't change much. That's what it means.
See, where I come from, sticky has different connotations, Sean.
Yes, you are from a different world to what I'm from, Michael. There's no doubt about that.
I'm from the gutter generation, I think you would call it. Well, let's move on quickly from that, Sean. What's the magic number here? Is there actually a number that will ensure a rise in rates next week?
Well, excellent question. I mean, of course there's not. But if underlying inflation comes in lower than expected, then the Reserve Bank has plenty of reason to remain on hold. In the minutes to this month's board meeting, the April board meeting, which were released last week, Governor Philip Lowe made it clear the bias remains towards lifting rates. Another 25 basis points would push the cash rate to 3.85%, that it's a new 10-year high. You're probably paying 7 point something, certainly high sixes on your standard variable mortgage rate. But bond markets have priced in only a 35% chance of a rate hike. And last month, it was bond traders rather than economists that got it right. Also, there's plenty going on outside Australia with the European Central Bank and the US Federal Reserve meeting in the next few days on interest rates. At the margins, what they do will have an impact.
Yeah, Sean, we heard yesterday, we talked about this a bit, that Westpac thinks the housing market has bottomed and prices will trend upwards from here, though only slowly. What do you think a rate rise would mean then for the housing market?
I mean, clearly it won't help. And probably what matters most is the commentary from the Reserve Bank. If it sounds like there aren't too many more rate increases coming, then the housing market should benefit. Now, Michael, you mentioned that Westpac reckons that the housing market has bottomed. The reasons Westpac have said that, and Chief Economist Bill Evans spoke about it, basically strong demand thanks to immigration and restricted supply. Those two should combine to put a floor under housing. Certainly the tide is turning in terms of views on the housing market. Several economists are just a little less pessimistic than they were a couple of months ago. But really the wording in the statement next week, following today's inflation figures, will really probably have a big influence on what happens to the housing market.
It is a big week for local economists and for investors. What's going on in international markets?
As we mentioned yesterday, it's a very big week on Wall Street for earnings, with more than 1/3 of the S&P 500 reporting March quarter figures in the next few days. Commodity markets have been pretty flat, Michael, although gold is back up towards $2,000 an ounce. Cryptos are struggling a bit. Not long ago, Bitcoin was trading around $30,000 a unit. It's now heading back towards $27,000 a unit. And the Aussie dollar is largely unchanged, fetching 66.7 US cents.
Okay, we'll be back in a moment with the rest of the day's business news. Sean, tradies and people with postgraduate degrees are the most satisfied with their jobs at the age of 25 and also earn the most money, according to new research.
Indeed. Nearly half of all 25-year-olds now hold a bachelor's degree, but they're less likely to be in full-time employment, have lower annual earnings and are less fulfilled in their career than their peers who did a trade apprenticeship or went on to do a master's degree. That's according to an AI study, which was first reported in the Financial Review. The study of 3,000 people over a 10-year period to the age of 25 tracked their post-school education pathways. It was done by AI Group's Centre for Education and Training. It shows that mass tertiary education and university degrees don't necessarily translate to job satisfaction. Since 2009, the proportion of young people with a degree has increased from 29% in 2008 to more than 48% nationally. Only 10% of younger Australians do an apprenticeship, but they seem to be the happiest of the lot.
It does seem quite convenient, doesn't it, that the ones who are the happiest at the age of 25 also seem to be the ones earning the most money. We did talk about that study previously that said that money does make you happy. And I think this study actually kind of supports that.
Yes. I think you need a bit more spirituality, Michael.
Hang on. You were the one that went all in on going, yes, money is the thing that makes you happy. Well, as far as I recall.
Yeah, something like that. Anyway.
Oh, okay. Australians will soon be able to renew their passports online through myGov as the government pushes to enable stat decs and deeds to be executed digitally.
Allowing documents to be in electronic form and to be executed using e-signatures is expected to save businesses and individuals about $400 million a year. That's according to Accenture modelling undertaken for a deregulation task force. More than 4.5 million deeds and 3.8 million stat decs are completed in Australia each year by small and medium enterprises and consumers. Now, this adds about 6 million and 9 million hours respectively to printing, filling out, signing and physically witnessing their execution. Modernising document execution would see the end of the practice of paper-based deeds and stat decs, which have been going on for centuries. Of course, they require all parties to sign in wet ink and to have the documents attested before physical witnesses. Couldn't come too soon, Michael.
Now, fund manager Dexus will sell 2 office towers in Sydney, each for hundreds of millions of dollars. But the real interest comes from how much less the towers are worth now compared to a few years ago.
I'm going to get slightly pointy-headed, Michael, but...
Oh, God. Okay, go on.
But it's important. So Dexus is selling 1 Margaret Street and 44 Market Street. Generally, they're well occupied, in good positions, considered prime real estate. 85 Castlereagh Street, known as JP Morgan Tower, is also being sold. The 3 are the first significant office sales in the Sydney CBD for quite some time. And they have ramifications for anyone holding office property because they provide a new benchmark for valuing office space. Just like home prices have fallen, so too have office building prices. But many big investors just haven't had to reflect that drop in their books because there's been a lack of asset sales to benchmark against. These sales could well lead to a bunch of revaluations from fund managers, which isn't necessarily going to be a good thing.
You set that up to be to be really a bit dry and a bit dull and a bit kind of...
I think boring is the word you were looking for.
But it wasn't. This is what I'm trying to say. That was really interesting, Sean.
It's really fascinating because we all have, own property companies in our super funds, basically.
Yeah.
And if they're worth $100 because they own all these assets, and suddenly they have all these sales and they have to revalue twice a year.
Yep.
So they suddenly think, there's a sale down the street which compares to ours. Maybe our office block is worth $9, not $10, or $8, not $10. It's going to be very interesting for that sector of the market.
Oh, it sounds like a heck of a sleeper story as well for the weekend edition. So consider that one now reserved.
Righto, it's yours. And Adam Lang, our judge, he'll love it. Just a little bit kind of intricate and, accounting-esque. He will love it.
Oh, yeah. No, I'm guaranteed the victory this week, Sean. Now, just about the best performing company on the ASX 200 last year was Whitehaven Coal. It's found things a bit tougher this year with coal prices tumbling, but it still wants to fast-track a new mine in New South Wales.
Whitehaven's Vickery project will be producing coal within 15 months. That's incredibly quickly after the miner approved a $150 million investment in a smaller, fast-tracked version of what it had initially proposed. Construction will begin in June on a mine that will be barely 13% of the size of the Vickery project that Whitehaven has permission to build after spending the better part of 5 years securing government approvals and fighting court challenges by environmentalists. According to the company, the plan is just to get the Vickery coal mine operating, particularly while coal prices are still high. Mind you, having spent 5 years going through the whole process to get the approvals, it does seem a little wasteful or something or other.
Last one, Sean, before we get to international news. Homeowners are delaying renovations for up to 2 years, including essential repairs, mind you, over fears about surging interest rates and living costs.
A national poll from Tradies service provider hipages found 43% of homeowners are parking renovations amid rising costs, and 28% are delaying for 1 to 2 years. About 40% of homeowners are worried about not having enough cash to finish a renovation. About 37% are concerned about having to stop halfway through the project because of cost blowouts. Now, homeowners are most likely to shelve kitchen and bathroom upgrades, landscaping and gardening and painting as they look to manage expenses. The irony is that homeowners who want to renovate will find it easier, of course, to find tradies to do the job, as the recent collapse of some building companies have freed up workers. And Michael, one of the renovations or the planned renovations that's most likely not to go ahead, home offices. 40% of homeowners say they no longer need the space post-COVID, and basically about a third of them are going to repurpose that space.
Oh dear. No, I'm a huge fan of the home office.
Yes. You just don't like actually meeting people.
I just don't like leaving home. I'm very happy meeting people, but I like to do it over Zoom. Actually, that's a lie. I don't think I even
No, you don't
that
even like that. No. Good texter, though.
In international news, Sean, Indonesia is winning the race to attract car manufacturers lured by the need for nickel and restrictive government policies.
Yes, quite fascinating. So Indonesia's President Joko Widodo has banned exports of nickel, which are critical to electric vehicle battery production. Indonesia is far and away the world's biggest nickel producer, about 4.5 times larger than number 2, which is the Philippines. So car makers have decided to set up value-added processors and refining in Indonesia. They're being helped by tax and other incentives, and at least they get access to nickel. For example, South Korea's Hyundai announced this month it's stepping up production of its best-selling all-electric vehicle in Indonesia. Ford and Volkswagen have announced expansion plans in the country. In Ford's case, it's actually the first ever investment in Indonesia, which is Southeast Asia's largest economy. Just a fascinating little story, that one.
Yeah, it is. There's plenty of confusion, Sean, around Twitter and blue ticks after a number of high-profile accounts saw their prized blue check marks reinstated, even though in some cases some of the owners of those accounts have actually been dead for years.
Yeah, yes. So celebrities and public figures took to the platform to deny having paid the $8 a month that yields the coloured tick, despite labels stating the account is verified because they are subscribed to Twitter Blue and verified their phone number. Unpaid legacy blue ticks, which once kind of conferred authenticity, I suppose, on accounts verified by the company, were removed last week as part of billionaire owner Elon Musk's push to boost revenue. But for many, they're back again. That's according to a report on Bloomberg. Users are speculating on whether the label is automatically provided to accounts that have 1 million subscribers or so, but there does seem to be a few key exceptions. For example, Ryan Reynolds, the actor, he's still missing a blue tick despite having more than 21 million followers. The other thing is that some dead personalities accounts also support the blue tick now. Anthony Bourdain, the celebrity chef, NBA player Kobe Bryant, both of those died. Bourdain in 2018, Bryant in 2020, yet the blue tick has reappeared on their accounts. Very unusual, Michael.
Yeah, it certainly is. And finally, Sean, luxury giant LVMH is closing in on Tesla for the 9th spot on the list of the world's biggest companies by market capitalization.
Yes, so LVMH's market cap just hit $500 billion, up nearly 7% this month. That's after renewed demand from Chinese shoppers boosted sales. Tesla's at $505 billion. Each share price has dropped quite a bit. Hence, we're almost getting to that crossover point. LVMH is the owner of brands including Louis Vuitton, Christian Dior, Moet and Chandon, Tag Heuer and Tiffany. Of course, the major shareholder is Bernard Arnault, who is the world's richest person, worth $212 billion, ahead of Tesla's Elon Musk. According to Bloomberg, the rally in LVMH's share price means Paris's benchmark CAC 40 index, which is basically the French equivalent to the ASX, that's now larger than the UK's equivalent, the London's FTSE. And, of course, you can't have a story like this, Michael, without going through the biggest companies in the world. Number one, have a guess. You've got to get this one right, Michael.
Well, it would be Apple, because
yes.
I think I referred to it as a humble startup on our weekend edition, and I think you laughed at me, rightly so.
Apple, then Microsoft, then Aramco, which is Saudi Arabia's oil company. That's number 3. Alphabet, Amazon, Berkshire Hathaway, Nvidia, Meta, Tesla, and LVMH at number 10.
All right. Sean, up next is the Fear and Greed Daily interview. Your guest today, Kate Burley, country manager for Amazon, Alexa, Australia and New Zealand, of course, a supporter of this podcast.
All about Alexa, what's next for Alexa, artificial intelligence, etc. Great chat.
Yeah, it's coming up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Wednesday, the 26th of April, 2023. Make sure you're following the podcast. Join us online on LinkedIn, Instagram, Twitter, and Facebook. And I mentioned Alexa before. Make sure you stay up to date on all the business news with Alexa and your Amazon Echo smart speaker. Simply say, Alexa, play the Fear and Greed podcast to catch the latest episode. You can grab yours now at amazon.com.au. And of course, today is Wednesday, which means there is a new episode of How Do They Afford That out today. And today we're taking a closer look at the issue of superannuation and the difference in super balances between men and women and what can be done to try and close that gap just a little bit. It is a very important issue, one we talked about on Friday, of course, Sean, when Canna Campbell joined us as well. And in today's episode of How Do They Afford That, we just dig into it a whole lot deeper. Find it wherever you listen to podcasts. There's also a link in today's show notes. I'm Michael Thompson, and that was Fear and Greed. Have a great day.